Hi, this is MJ Nodillo here with your June edition of the Pathlight Insight. We intentionally held off on distributing this month until after the U.S. Federal Reserve and the FOMC met today to discuss the direction of interest rates. And as expected, they decided to leave the Fed funds rates unchanged at a range of 1/4 to 1/2 percentage point. What did change, however, are the expectations for 2016 and 17. The overwhelming consensus of FOMC members is that there will likely only be one rate hike this year, and in fact, expectations are for fewer than previously anticipated rate hikes in 2017. This leads into our long believed thought that interest rates can stay lower for longer. Now, a lot of people have thought in a very elementary way that if you printed a whole bunch of money, that inflation would become rampant and therefore interest rates would rise. Well, that just hasn't materialized. Part of the reason is that global capital can really go anywhere right now. And when you look at the strength of the U.S. economy, the strength of its currency, and our current interest rate regime relative to, say, Germany, which has negative interest rates, Japan, which is negative as well, it's still an attractive place for people to park their money. So while we certainly don't want to get in the game of guessing the long-term direction of interest rates, it certainly is conceivable that they can continue to stay lower for longer than anyone really had thought possible. Now, moving to another major piece of news that has been in the financial markets lately, and that's the concern over Britain leaving the European Union. Now, as media outlets love to do, you've got to coin a phrase. So this is now called the Brexit. You know, in the past we had the Grexit for the Greece concern leaving, but now it's focused on Britain. And Parliament is meeting to discuss a referendum on June 23rd whether or not they want to stay in the European Union. Now, the reality is a lot of people really don't know what this means. You know, they don't share the euro currency. But the bigger concern is what this does to trade and direct foreign investment. You know, if those two things were to stumble, then it could certainly have an impact on Britain's economy. But we'll have to wait and see how this plays out. In the interim, we certainly know that issues like the Federal Reserve and what they do with interest rates, and now Britain potentially leaving the European Union, are macro events that are likely to create short-term volatility in equity markets. But not necessarily is it known what it's going to do to the long-term direction of the global economy. Hope you found this interesting. Please give us a call with any questions. Thank you very much.